for a few current students. So this is the beautiful INSEAD campus. It's a little bit different right now, right, due to COVID, but it actually continues to be vivid and alive. They're all kind of COVID-related security measures, but we still have the same kind of vivid campus spirit, I would say. This is where I'm originally from. You've probably already heard from the accent. I'm originally from Germany, specifically from the beautiful town of Heidelberg. Fun fact about Germany, there is no fun in Germany, so let's go back to work, right? There's a different way of telling this joke. What is the meaning behind the colors on the German flag? The black, the red, and the yellow stands for work, and the blue stands for humor, all right? In case you're wondering, this is about the same reaction my jokes get into the classroom. There's typically dead silence when I tell a joke. So one thing you could actually do to make this whole thing a little bit more interactive and entertaining is that every time I say something which you find funny, you write like ha 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 or LOL into the chat room, all right? I will say it has happened in the past that people then write ha 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 when I did not try to tell a joke, but that's then kind of funny in its own way, all right? So we'll take it from there. In terms of my background, so I'm an assistant professor in entrepreneurship at INSEAD. I have been at INSEAD for 6 years by now, since September 2014. Before that, I got what's called a Diplom Kaufmann at the University of Mannheim. I was an exchange student at Sciences Po, which is a little bit more of a policy school. I got a master's degree from the London School of Economics, and I got a PhD from Stanford University with focus on entrepreneurship. Before actually entering academia, I had created a web design company, which I sold in 2016. The material we're going to talk about, I teach to undergrads, PhDs, MBAs, and executives. Undergrads, not so much anymore, because at INSEAD we don't have an undergrad program. I used to do this at Stanford. So these days I mostly kind of teach towards MBAs, global executive MBAs, and like executives. I work with corporations and so on. Okay. When I'm not teaching or not doing research, this is pretty much the center of my life. On the left-hand side, you see my son Hector, who's hopefully in school right now. Yeah. So here's the thing: we're going to spend about 3 hours with one another, and I want to make sure you really get the most out of the class. And they are basically, so here's like a strategy how you get the most out of the class. All right. So there I would say like 4 types of learning for today's workshop, and I would actually say this is something you can apply to any workshop you take. In fact, any kind of learning. All right. So first type of learning is everything you can steal. Okay. Stealing means you can make use of whatever we discuss immediately without changing anything, all right? You just lift it, and please don't worry, you don't have to tell anyone where you stole it from. So this is to say, you can go out of the meeting, you talk to your partner, you talk to a colleague, and you say, hey, do you know what the blue in the German color in the German flag stands for? Humor. And the person thinks you're funnier than you actually are. And guess what? I stole that joke myself. All right? So the more stuff you can just kind of lift and take away, the better. And the more you do, the more you will learn, the better it is. All right? The second category is what I call inspiration. So what we talk about is useful to you, but it requires some work or some tweaking. Okay? So you need to say like, oh, look, this is like really relevant for my life. I'm immediately going to use this. I'm going to use this. I need to adjust this a little bit. And I don't know what this is, right? This can be like the design of a slide. It can be like a presentation technique. It can be something about startups. It can be something about venture capital. You might use it if you talk to an investor, to your team, or so on. All right? The next category, that's probably my favorite category, is an oyster. So what we discuss is interesting to you, but you do not yet know how it is useful to you. Okay? And so let me give you an example. When I was a teenager, I got like super obsessed with Formula One. I wanted to understand everything about who races these cars, how they configure these cars. There was no use in it whatsoever. I just collected everything and tried to learn everything about Formula One. No use at the time, but then 20 years later, I decided to study high-performing organizations. And in what kind of context can you study well high-performing organizations? In Formula One. And so all this knowledge I built up like 20 years earlier came incredibly handy. So sometimes there might be something where you say like, look, this is interesting, I'm not sure how it's useful, but then take a note, and I'm confident it'll become useful at some point in time. There's probably a reason why you find it interesting. And finally, there's stuff which causes you discomfort. you do not understand what we discussed or you disagree with it. And this is obviously great because learning should actually come from you not learning only happens if you don't understand something or if you disagree with something, right? The idea here is not that you agree with everything I say, then you don't have to say. By the way, for people who are posting their LinkedIn kind of profile, I'm going to create a community at some point after this webinar where you can access one another. It's also not particularly effective. Nobody's going to click on all these LinkedIn profiles. So I'm going to send out an email like in a few weeks or month and say like, look, if you want to come together, here's like the community. You can connect with people. So these are the 4 categories: stealing, inspiration, oyster, discomfort. All right. You need to take notes. All right. Taking good notes is crucial on the way up. There's very strong research directly linking the quality of notes people take to the learning success they have. So if all you do is basically kind of sitting back and listening for the next 3 hours, you're not going to get like a ton out of it. Let me kind of directly anticipate a question some of you will have. Will there be a recording? Will you get the slides? And the answer to both of these questions is a beautiful no. You will not get the slides and there will not be a recording. And let me briefly explain why, all right? I recently taught this class to like a bunch of executives. There were like 100 executives. And everybody said like, look, Henning, we need the slides, we need the slides, we need the slides. All right, these people have paid a lot of money. And I said like, okay, I'm going to give you the slides. But here's the thing. As the very first slide in the deck, I put a slide where I said like, if you contact me within 1 year after me teaching you that you've opened this slide deck, I'm going to transfer $100 to you, no question asked. Now you should think like, oh, Henning is kind of crazy because 100 executives take the class, he gives them the slides and he promised everyone $100. That could cost him $10,000. No, it cost me $200 because 2 of those 100 people who all wanted to have the slides actually opened up the slide deck. Let's face it, after this meeting, you go back to your emails, you go back to your WhatsApp, you talk to your colleagues, you talk to your partner. The last thing which is going to happen is that you suddenly say like, hey, I have 3 hours, let me kind of dig back into these slides and present them. So instead I will leverage FOMO, your fear of missing out. Whatever you don't squeeze out of these 3 hours, you're not going to get, all right? So pay attention, take good notes, and you will learn a ton as a result. All right? When you take notes, try to use these categories. Is that something you can steal? Is that something that inspires you? Is it an oyster? Or is it something that causes you discomfort? Honestly, I expect you to be like a sponge that sucks up everything. Instead, you should think about this as like a bunch of nuggets where you say like, look, this nugget is relevant for me, this nugget is relevant for me, and you take away what's interesting for you. The question I get quite frequently is like, what is the one takeaway from your 3-hour webinar? And I feel like, what kind of shit webinar would that be, where there would be one takeaway? I hope there are actually more than one takeaway, but here's the thing, these takeaways will be different ones for different people, and it's your responsibility to actually write these down and take away what is most helpful to you. So be a little bit like a reader who kind of highlights what is particularly interesting to you, all right? So you can constantly ask questions, all right? So you have question authority. The way to do this is that you just use the chat. I will constantly monitor the chat, okay? So please try to keep whatever you kind of say in the chat somewhat short, because keep in mind, I will always read this in parallel while I do the talking. So I've done this a few times and I have become pretty good in reading the chat in parallel, but try to kind of keep it in a moderate level so that I can pursue this, so that I can still pursue this on the side, okay? But don't hesitate to ask questions. If I don't engage with your questions, there are 2 options. First, maybe we get lucky and somebody else knows the answer to it and can actually answer it. This has been one of my highlights, that students or participants have answered each other's questions. The second thing is there's going to be a Q&A at the very end, and so you can just bring your question up at the end again, all right? So you need to pay attention. This is obviously key. The class does require focus, okay? These are basically weapons of attention distraction. Research is very clear on this. If you spend attention for about 10 seconds to your mobile phone, it takes you about 25 minutes to go up to your original level of concentration. So there is just no way to say like, oh, I'm just going to briefly pay attention to this WhatsApp message. I obviously cannot tell you like how you should kind of allocate. So here's another way of thinking about this, okay? Your attention is probably the most valuable resource you have in your professional life, and to a certain degree also in your personal life. Here's the thing, if you actually kind of check your emails in between, what you're basically doing is to say like, I outsource the control rights for the most valuable resource to whatever random person felt like sending me an email right now. And I can't tell you how you should allocate your attention, but giving it to some random person is probably not the best way of doing it. All right? So for the next 3 hours, I'll ask for your attention. It will also help you to actually cultivate a relationship with your fellow participants, with me, and so on. All right? It's very difficult to actually develop a relationship if you're in parallel with the phone with someone else. In terms of the format, you already get a feeling for it. This will be an interactive monologue. So I will talk a lot, but I will constantly kind of engage you, kind of get your questions in, and I want to hear from you. PowerPoint slides will rain down on you. I know it's very difficult to actually pay attention for 3 hours in a row, and so I will do my very best to stimulate you intellectually as well as visually. Okay? In terms of the roadmap, there's going to be a lecture part, there's going to be group work, and there's constantly going to be the chat where you kind of share questions, ideas, comments, and so on. All right? So I will draw on cutting-edge research, accounts of entrepreneurs, venture capitalists, business angels, and also my own experience. This is a little bit the table of content, but then it's not. So because we're only going to talk about the first 3 points. We're going to talk about a primer in venture capital. We're going to talk about how you get access. And access here from both sides. How do venture capitalists gain access to ventures, and how do ventures gain access to venture capital? And then we talk a little bit about screening, how people actually screen one another. All right? So that is very much the idea. We're not going to talk about negotiation and how you collaborate. The reason for that is very simple. Normally when I teach this material, I have like 2 or 3 days. All right? And quite a bit of stuff ends up on the cutting floor. So this will give you like a good overview, but we are not going to take a deep dive into every single topic. Okay? So let me quickly catch up on questions. First, I know there will not be a certificate. All you will do is learn. And Michael, no, our company at the time was completely customer financed. And we were very quickly cash flow positive, and we never needed to raise any venture capital. So this is a fun topic to teach at venture capital at INSEAD, because the person who's kind of seen as like the first venture capitalist, Georges Doriot, is also the founder of INSEAD. So let's give a little bit of background here about like the position Georges Doriot was at the time. The Second World War was over, all right? And at the time he was a professor at Harvard Business School. And what he realized is, oh wow, now with the end of the Second World War, the industry is fundamentally going to change, right? Because all these men who became soldiers will not in the same amount become soldiers anymore, and kind of the same kind of facilities like producing tanks, producing guns and stuff like this, producing airplanes, that is also going to change because we're not doing this anymore under extreme pressure. And so he assumed there will be new kind of companies, even new kind of industries, but there's not a good financing instrument for these kind of new kind of companies, right? Imagine you go to a bank and you ask for a loan and you say like, look, I want to create a biotech company, and with a chance of 80%, the thing is going to go broke, but with a chance of 20%, it's going to be amazing. It just doesn't make sense. The instrument of a classical bank loan is just not really compatible with that, right? So you need a different instrument, and that is pretty much venture capital. So, Michael, I'm not sure if I got your questions. Yeah. So here's the thing about the venture capital industry. The best way to predict the future is to make it. The second best way is to finance it. All right? And so this is quite a beautiful take on the industry. It is a relatively tiny industry if you think about it, right? Venture capital seems to be everywhere, but if you compare to other parts of the financial industry, it's very small, right? You can see this here. The assets of the 2 largest US hedge funds are $353 billion. The assets of the single largest US private equity firm is $512 billion. And the assets of all active US venture capital firms is 444 billion, right? So the sum of all venture capital firms is still less than the single largest private equity firm. However, it's an enormously influential industry because it has an enormous amount of lever, right? You can see this here. It just invests a small fraction of the US GDP, but 42% of all public companies are or were at some point venture-backed. Venture-backed companies represent 63% of the total market capitalization, and venture-backed companies account for 35% of total employment and 85% of total research and development spend. So I'm obviously not suggesting that this is causal, right? But here's the thing, it gives you a feeling for where this industry is basically operating, right? It really is kind of in this high growth, kind of research, innovative kind of company, okay? There's a beautiful way of thinking about this to go back to this definition by Howard Stevenson. Entrepreneurship is the pursuit of opportunity without regard to resources currently controlled. And I always find this an incredibly liberating way of thinking about the world when you can think of like, look, what opportunities, and let's forget a minute about the resources I would need to kind of act on these opportunities. But here's the thing, no matter how great your idea is, at some point you need to have the complementary resources as illustrated here by this puzzle piece, right? And this is very much where venture capital comes in. Venture capital helps you to build up these complementary resources that you need to make your idea a reality, all right? So, first question to you. Why can it be crucial for startups to raise money from venture capitalists or business angels? Please type your response into the chat. Yeah, grow faster, validation, very good point. Experiment more, potentially, we're going to talk about this in a second. Accelerate growth, pay unavoidable bills, I like the way you put it. Coaching and guidance, very true. Right, so this is, you're hitting on a lot of the important points. Some of the good points, there are like one or two aspects which are also missing. So let me provide a little bit more of a systematic structure here, all right? So why can, and the can is very important, just because they can benefit does not imply that they benefit. So the first thing, super simple, but you get money, right? The venture capitalist, you sign the contract, and like a few days later, money ends up on your account. And now you can hire, you can scale, you can accelerate. But beyond that, right, you also get advice and mentoring. You avoid mistakes, you can grow faster. Look, this is why people very often say there's dumb money and there's smart money, right? When they say like this, money often comes here with additional advice. Beyond that, there's also the governance aspect. This might be the very first time for a CEO to set up actually a company, or for the founder to create a company. And the VC might actually have plenty of experience in making this happen. Where do you file? What kind of capital structure do you deploy, and so on. Then there's this aspect of status, reputation, trust, credibility, right? If a venture just starts out, people might not have a lot of trust in you. But if you can then say, look, I have a prestigious venture capitalist who just invested in me, it really makes it easier for you to kind of attract other people to work with you. Then there's the issue of referrals. People can actually introduce you to other people, right? So these VCs very often have a big Rolodex with lots of fantastic people in there, and they can kind of introduce to potential partners, to people who hire you, people who can give you good advice. Then there's what's called the social defense, and this is quite an interesting aspect here. So imagine the following. There's like a small venture, all right? And this small venture now collaborates with a large corporation. And what can happen is that the large corporation says like, you know what, screw the young venture. We are not going to pay your invoices, and we are going to misappropriate your intellectual capital. For example, we're going to steal your patents or something like this, all right? And you see, if you're a small venture, there's very little you can do about this. But if you have money from a prestigious venture capitalist, the venture capitalist can do two things for you. The first thing is it can actually help you to lawyer up, right? It can actually give you more resource and say like, look, let's hire like a bunch of lawyers and we're gonna go against the large corporation. So you can actually fight for your right. The second thing which happens is that the venture capitalist is typically well connected and will, of course, that's its very job, invest in ventures in the future. And so the venture capitalist will go to the large corporation and will say, look, feel free to kind of screw with our venture here, but here's the thing. If you continue to do this, if you continue not to pay invoices, if you continue to misappropriate intellectual property, we will tell all the ventures we work with and all the other venture capitalists to work with that you are not a trustworthy corporation. And that is something the corporation cares a great deal about because they know they are dependent on ventures in the future working with them. And so this is like a reputational kind of pressure on them that they continue to work with them. All right? So here are the reasons why you benefit. Now you might say, look, I can just do this on my own. I don't need that. And look, I'm actually in many ways in favor of this. 99% of all companies on earth get created without venture capital. And numerous companies of these are incredibly successful. So it's not as if venture capital would be a necessity. But one thing you want to think through is maybe you can make it without venture capital, but also consider what happens if you try to make it without venture capital, but your competitors raise plenty of venture capital, right? You are typically in a competitive market, and that is something you need to take into account. So what can happen is that your competitor may raise more money than you and then outcompete you in the operational business. So whatever you've done in the financial market kind of spills over into your operational business. So let me give you a recent example of this, all right? Take the competition between the two ride-sharing services, Uber and Lyft. Uber just outraised Lyft in the financial markets. They raised billions and billions of dollars. And what they then did with this financial capital is that they actually lowered their prices in the marketplace. They poached away their best software engineer. They poached away their best drivers, and so on and so on. And so it became incredibly hard for Lyft now to compete in the marketplace. So the advantage they built up in the financial market now actually spilled over into the operational business. Okay? Of course, there are also plenty of reasons why you should not raise venture capital, all right? And I want to be very transparent about those. So, alternative forms of financing might be more advantageous. It might be that you actually say like, look, I can raise much more money from family and friends, or I can actually go on Kickstarter or so on. So there might be there's a whole what is called a funding buffet, right? You have all these kind of different options you can go to. Then there's also, you dilute your share, right? There's a loss of power. Look, if you raise money and somebody gives you like $1 million or $2 million, that venture capitalist or that business angel will actually want a share of your company. Look, for example, at the companies who recently went for IPO. So, for example, take the DoorDash IPO. The founder of that company still only owns at this point 4% of that company. Think about it. The founder of a company which became incredibly successful ends up with 4%. So don't get me wrong, 4% of having DoorDash is still fantastic, and he will never need to work a day in his life again, but still you can see how much you can dilute it over time. And then it also takes an enormous amount of effort to raise venture capital, right? You see, it's not as if you kind of call up a number and say, please transfer me the $1 million. No, you actually need to talk to a lot of people, you need to prepare a pitch deck, and so on and so on. So it takes quite a bit of time to do this, okay? Victoria, regarding your question, do you consider business angels under VC here? Yes, very much so. So the business angel would just be very early in the process, right? The business angel would somebody who says like, look, I'm going to give you like 150,000 euros or less, right? Maybe 50,000 euros. And I help you to get your business a little bit off the ground, right? So you can develop something. If all you have is like an idea, but you kind of don't have the resources to market it, that money will actually help you to kind of take it off. But immediately you lose like 5 or 10% or so, okay? There's very nice research on this here, for example, by Toby Stewart, that having a high prestige venture capitalist actually helps you with IPO pricing. And obviously, even if you're not yet thinking IPO, this kind of just shows you, look, the reputation or the status benefits I get from these kind of endorsements has a positive effect on the people surround me, on other people I want to work with. There's also great work by Shea Bernstein. So the monitoring actually has a positive effect on venture performance. So they actually find a way to identify how much time a venture capitalist spends on a particular venture. And what they can show is the more time a venture capitalist can devote to a particular venture, the better the venture tends to do. All right? So this advice you get actually seems to help. So what I will do now in the next, in the remainder of the workshop, that I help you a little bit to navigate that maze of venture finance. So while this is very complicated, I hope that at the end of the workshop, you're going to have a little bit of a better overview. There's still going to be a lot of moving parts in here, but it hopefully kind of sets you off in a good way. Nina Lu asked a fantastic question: is that selection bias? Venture capitalists spend more time on promising projects. Nina, you should, just the way you think about it, you should probably consider getting a PhD. Love the way you think about it. The way the paper does it, what I cited is, they actually look at changes in airline routes. And if an airline route made it easier for a venture capitalist to connect to a particular venture, they assume that then the venture capitalist would spend more time on that particular venture. So this is actually here, the attention the venture capitalist spends in person with the venture is actually endogenous. But very good question. Otherwise, you're of course right. There's actually plenty of research which shows that the resources, in part my dissertation was on the topic, that this is to a certain degree endogenous, how much resources a VC actually spends on the ventures. Okay? So, luckily there's a ton of research on venture capital, so we can actually learn about this maze. And also, venture capitalists are incredibly communicative crowd, so they share the material on Twitter, on blogs, and so on and so on. So we can actually learn about it. All right? So, let's start with prime and venture capital. How does the money flow? All right? So, I will often use the venture capital firm Andreessen Horowitz A16Z as an example. There's no particular reason why I picked this venture capital firm. What makes it kind of attractive for our purposes, it's a relatively young venture capital firm. And so we can actually see, like, what does it take more recently to actually find your way into the industry, okay? So at the center of all of this is the venture capitalist, also called the general partner. And that venture capitalist then transfers money to the entrepreneur. We have already talked about this, right? The VC brings money, advice, status, and so on. The entrepreneur approves an idea and the willingness and ability to work very, very hard. But now, let's kind of, to really understand how this ecosystem works, let's extend the focus a tiny bit, all right? So let's look at the money flow. It starts actually with limited partners, and the limited partners give the money to the venture capitalists, which the venture capitalists will then invest. And there's also a little bit of a management fee of like 2 to 2.5%. So, who are, in your opinion, limited partners? Who are the kind of institutions, organizations, investors that give money to venture capitalists? Please type your answer to the chat. Pension funds, correct. Family offices. Yes, universities very often, universities, endowments. Basel wrote like, Adamiela wrote Stanford, all kind of universities. The Yale Endowment Fund became very famous. High net worth individuals, accredited investors. Yes, again, high net worth individuals. Sovereign wealth funds, investment banks, not so much, but from time to time, you're right. Family offices, more and more, absolutely correct. Yeah. Insurance companies. All right, let me ask the question a tiny little bit differently. Could I, personally, Henning Pisunka, could I invest into a venture capital fund? Could I become like a limited partner and invest my money into a venture capitalist? All right, whoever writes yes, you have a completely wrong understanding what an assistant professor at INSEAD earns. I'm not a high net worth individual. This would be so nice. If you want to change that, maybe you can make a donation to INSEAD and say like, earmark it and say like, this is for Henning Pisunker so that he can finally invest in a venture capital fund. So in principle, you're right. I could theoretically do this, but you see, as long as kind of companies like Andreessen Horowitz can go to Prudential and say like, hey, you want to invest like 500 million, there's really no point in engaging with me, who puts together, where it saves like a little bit of a salary on a monthly base. Why engage with somebody like me, right? They go for actually much, much bigger investors, okay? So, I'm glad how much joy people take out of the fact that I can't afford this. This is like the German emotion of Schadenfreude almost. Great, I love it. So the money then goes to the entrepreneurs and ventures. And then at some point we have a liquidity event. Somebody's an idea what a liquidity event is? Where does the money come from? Yes, an IPO or mergers and acquisitions, you're absolutely right, all right? So, and then the money is available, right? There's this liquidity event, and then the money can be split. But before we look into how the money is split, let's have a look a little bit into the kind of liquidity events. There's a nice saying, nothing counts until it's liquid, advice from a long-time investor, right? You see, you can actually own something. For example, if you have like a fantastic picture which you inherited from your grandmother or your grandfather, but if there's not a market for it, it might be great, but it's probably not like a valuable asset. So if you can't liquidate it, it's very difficult to determine the value. So let's have a look at what are the kind of exits and how these were liquidated. What you can see here is the percentage of total exits, okay? And you see the split between IPO and M&A. And what you can obviously see in the 1980s, it's basically only IPOs. Every venture that exited did so via an IPO, all right? And this is completely turned around now, right? Now it's basically almost only mergers and acquisitions. And the reason why this has happened, there are a bunch of reasons for this, all right? The primary reason is probably that companies like Google, Microsoft, Facebook, Apple actually realized, look, all these ventures, we are afraid that they are going to kind of disrupt us. We are going to instead invest in them and buy them. And that's like for us an opportunity to actually continue to grow tremendously. And these companies which could have gone for IPO otherwise end up instead in a merger or an acquisition, right? Think in the case of Facebook, think like WhatsApp, think Instagram. These are all companies which could have gone for an IPO potentially, but didn't and instead got bored, right? The other thing about it is that people were like concerned about like, look, it might be very difficult to manage a public company. Why don't we just sell this company? All right. And for the founding team, that's very often it kind of can make more sense to say like, look, rather than continuing to take an enormous risk, why don't we just cash in? We'll all be fine if we get like $1 billion from Google. All right. Igor, I think this is deal count. If I call the charts, we call the charts correctly. Yeah. Raf points out that SPACs are used in the US right now. That is absolutely true. SPACs is a phenomenon or like an instrument which might actually shift this more back towards IPOs. I would say the judgment is still out on that. We've seen a lot of SPACs in 2020, continue this in 2021. Let's see how this changes things in the long term. All right. You can also see that the number of years it takes actually to go for IPO has increased tremendously. It used to be about 8 years, and now it's more about 11 years in the time you actually take from founding of the company to actually going for IPO. Let's take an example here with some real companies, all right? So Amazon got founded in 1994, goes for IPO at 1997 at 661 million. I didn't check this, but I believe the current valuation of Amazon is far beyond $1 trillion. So a good investment. So it went up more by a factor of 1,000 since the IPO. Google went founded in 1998, then went for IPO 2004 at 30 billion. At the time, everybody said, "Oh, this was all overvalued." Also became a $1 trillion company. Facebook took even more time, got founded in 2004, then went for IPO 2012 with 117 billion. Uber took even 10 years, all right? The reason why it takes longer and longer for these companies is because you can raise more and more money in the private markets. And so they very often delay the time, okay, until which they go for an IPO. This is not necessarily a good thing, right? You see, because the great things about public market is that very often public markets can actually, in particular in the context of an IPO, do a very, very good due diligence. You've seen this, for example, in the context of WeWork, right? That company had actually grown and grown and grown in private markets, but the moment it had to go public, people realized, oh, look, this is basically like a house of cards. This is not actually a worthy company, all right? Two other aspects about this chart, which might not immediately be evident for you, all right? One thing which you see, like a question I often get is like, Henning, do you think we are currently in a bubble? And obviously I don't know the answer to this, but what I do remember is that when Amazon and Google went for IPO, everybody said like they are tremendously overvalued. In the case of Amazon, they increased by a factor of more than 1,000, right? So I can't tell you whether we are in a bubble, but just because somebody's shouting we are in a bubble is not a particularly strong indicator of whether we are in a bubble, all right? The other thing about this is I find the fact that these companies stay private for longer and longer actually somewhat concerning. And here's the reason for this, right? You see, there are a lot of kind of private retail investors who became rich by investing in Amazon, right? The key thing about this is people who play in private markets tend to be people who are already rich, right? Who already have a lot of money on the side. And if more and more of this growth is basically realized in the private market, it becomes a smaller and smaller chance for retail investors actually to participate in this growth, all right? So that's getting a little bit trickier. So in an odd way, the fact that these companies stay longer and longer private, all right, has the consequence that it might actually increase inequality in society. So in Uber, the last time I checked this, everybody who invested after 2014 did not actually make money on the company, but everybody who invested before 2014 actually made a lot of money in the company. But now think about it, the people who invested before 2014 are probably people who are already like very well networked, who already have like a lot of money and so on, okay? So now the money actually gets split, okay? Part of the money goes to the founders and part of the money becomes the VC cumulative net income. So the VC, let's focus on the VC cumulative net income because that is now split. So part of the money becomes what's called the carried interest for the venture capitalists. So this is typically like 20, 25, sometimes 30%. This is also why venture capitalists would often refer to their business model as 220 because they originally take like a fee of like 2% on the capital, but then also they get like 20% of the actual profits they are generating, all right? And then the rest of the money goes back to the limited partners, and this kind of concludes the hopefully vicious circle of, the hopefully virtuous circle of venture capital. When the limited partner invests to the venture capitalist creates entrepreneurs, the entrepreneurs become successful and the money flows back, and this dynamic continues and continues, and new great companies are created. That's the very idea, okay? So we will focus on this dyad here between the venture capitalist and the entrepreneur, okay? So let's think a little bit about VC as an asset class and how this compares to other, right? These are like the stock markets. I know these are images which are like from the late 1980s. I just like the images so much. I know that public markets don't look like this anymore. But you see, you can see these huge stock markets where people kind of exchange information, they exchange money, and this is what has happened all around the world, right? So the information is public and people rush to kind of make things happen. But here's the thing. So here's the question. How do you think is investing in ventures as a VC different from investing in stocks? Please share your thoughts in the chat. How is the two different? If I invest in a venture as a VC or as a business angel, or if I buy a stock? High risk, high return, risk, not liquid, no governance, very good. Yes, absolutely, you cannot sell any time. Let's kind of run through this a bit more systematically, all right? So, here an important aspect, returns on investments are more skewed, right? It's just very common that a venture would either go like become very successful or bust. Public companies normally don't have such a crazy distribution, at least not in the short term. You cannot reverse your trade, right? So here's the thing, if I invest in like 3 founders in Paris this morning, and then in the afternoon I think like, oh my God, this was a shitty idea, how do I get out of this deal? There is just no way for me to do it. I am really stuck in this, okay? By contrast, if I buy Tesla stocks this morning, and in the afternoon I think this was a shitty idea, I can just sell, all right? You cannot invest in competitors if you're a venture capitalist. At least you're not supposed to. I know there are quite a few venture capitalists who actually do this, but you're not supposed to do it. And the reason for that is you're not just supposed to provide money, you're also expected to foster the venture, to help the venture, all right? Then the publicity of information, the very idea of public stock markets is that all the information is public. So if, for example, now one of you on the call, like Patrick, would tell me, hey, Henning, I know something about Tesla nobody else knows, I would be like, Patrick, are you engaging in insider trading? Because you're really not supposed to do this, right? So the only way how we can actually make a profit is by saying, like, I come to a smarter interpretation of the information which is already out there. So I kind of see something in the data that other people do not see, or I grab some data point which is like legitimate to grab. But the idea is that the information is typically public, all right? The information is also unevenly distributed with venture capital, okay, with ventures. So with ventures, it's not public at all. These are just like 3 people working in a garage, and it might be that one venture capitalist knows them extremely well, the other not at all. And this is something we will return to later on. The access is very difficult. Imagine I wanted to buy Tesla stocks today. Who do I need to ask if I wanted to buy Tesla stocks? Somebody's idea? So, Ramsey, you're absolutely right. I don't have to ask anyone. I can just open up my app and I can buy it. I don't need to ask prior investors. I don't need to ask the CEO. I don't need to ask Elon Musk. I can just buy it as long as there's a seller who's willing to sell at the price at which I'm willing to buy. But this is not true in the context of a venture. I need to have the agreement of the prior investors. I need to have the agreement of the founder, all right? So it's much more complicated to actually invest. If I say like, hey, look, Stripe looks like a promising kind of high growth venture, I want to invest, I cannot simply invest, okay? Let's have a look a little bit at the returns here, but don't have a look at the absolute returns. Just have a look at the dispersion from the median, okay? Like the standard deviation, how much does this vary? And what you can see at the very right, a taxable mutual fund. And you can see, so the line actually kind of captures the median, and then you see the 25th and the 75th percentile in the bar, and then the kind of the small line gives you the 95 and the 5th percentile. And you can see there's really not a lot of variation in taxable bond mutual funds. So if you invest in a taxable bond mutual fund, please, please, please do not spend all that much time trying to pick which fund you will invest in. It really doesn't make a big difference. But if you invest in venture capital, you can see this here, right? There's a huge variation around the median. So the top 5% companies make more than 45% more profit, right, than the median, and the worst one make more than 35% less than the median. So here you want to spend a lot of time to actually invest into the right venture capital fund, okay? If you look at the distribution of this, right, here you can see the standard deviation and you can see the annual return, and you should immediately realize, okay, venture capital seems to be a high risk, high return asset class, and indeed it is, okay? What's the difference between venture capital and private equity? Look, the two are obviously related, both are in the private market, all right? But what you do in venture capital, yes, an LOL, thank you so much, a single one at least. At least like, so what private equity does, private equity would say like, look, we might actually buy a company and find a way to actually make it more effective. So it would be absolutely not normal to say like, we are gonna buy like a supermarket chain and we find ways to tweak this a little bit and to make it more effective and more profitable, all right? by contrast, what venture capital does is really we're going to help the creation of new companies, whereas private equity takes existing companies and makes them more effective. Okay? So let's have a look at the industry dynamics. Venture capitalists have changed, and alternatives to venture capital have emerged over time. So I want you to pay attention to 3 aspects of this chart. All right? Let's have first a look at the left hand on the y-axis on the left-hand side. The cost of starting a technology company. And you can see that is constantly going down and down and down. And you should have an immediate feeling why that is the case, right? If you actually kind of try to create a tech company like 10, 15 years ago, you would have said like, oh shit, I need to buy like a server, I need to hire a programmer and stuff like this, I need to build my own content management system. Nowadays, you would go to AWS and you kind of say like, hey, I'm going to do this, I'm going to do this, and I'm going to download this kind of Joomla template and so on. And you basically, you are immediately, you hit the ground running, right? So I just talked to a professor who was a little bit older, and he said like, look, it used to be that I talked with students about their ideas, and then 5 or 10 years later, they came to me and said like they realized they implemented this. And nowadays, I talk to students and talk with them about their idea, and what they do is that they implement it within 1 or 2 weeks and show me the implemented idea. So the cost of creating a company has just gone down tremendously. At the same time, what has happened, you can see this on the right-hand side on the y-axis, the number of deals which are seed funded has gone up and up and up and up. And now you see these aspects. On the one hand, it has gotten cheaper to create a company, but at the same time, there is more. And this has led to the saying, it has never been easier to start a company, more difficult to make it possible. Just from a strategic perspective, what you're basically seeing here is an enormous kind of lowering of entry barriers, right? It's relatively easy to kind of get into the market, right? So, now let's look at kind of front end of this chart. We started in the 1960s, 70s, 1980s, right? So, there's Greylock Partners, there's Sutter Hill, Charles River, right? This is really just kind of, this is very much the world Georges Doriot, what I talked about in the beginning, operated in. This is a bunch of people, typically at the time, always guys, right? Unfortunately, still mostly guys, right? Who actually said like, look, you have a risky company, we're going to give you some money on this. Then in the 1990s, you see like more and more brands emerging, companies like Sequoia Capital, because what they realize is, look, we actually need to compete for capital to invest, but we also need to compete for the opportunity to actually invest into these ventures. In the 2000s, you then have more and more of a focus emerging that these venture capitalists, so 1 or 2 people have actually written something about the slide. Does everybody see the slide where you see like risk capital, brands, emerge, focus, international, super angel? Excellent. Thank you so much for the review. Perfect. All right. So in the 2000s, you have then this emerging focus, right, like the Founders Fund. Let's think a little bit about what it means to actually focus in this industry, right? So there's the general saying that you have basically agglomerators versus specialists, all right? Let's pay attention to 2 axes here. Let's first take a look at the horizontal axis. You can see some companies actually become stage specialists. So they would say like, look, we only invest in like seed stage, or we only invest in like a Series A, or only like late on in a Series F. And then there are other companies who are actually multi-stage, all right? The other dimension is the vertical axis I want you to pay attention to, is that you can be multi-sector, or you can be a sector specialist, all right? So a sector specialist would mean I only invest in e-commerce, or I only invest in robotics and so on. But then at the same time, but you can also, there are a lot of companies actually, who go into all kind of sectors, all right? So what else happens? Then VCs become more and more international. At some point in time, more than 50% of the worldwide venture capital was invested within 20 square miles of Palo Alto, okay? And then people realized, look, there must be like great entrepreneurs somewhere else, and so these VCs became more and more international. New kind of venture capitalists and business angels then formed. There's super angels and micro VCs. What had basically happened is that these venture capital companies had grown fairly big. And then super angels said like, look, I just want to be like me alone and I have a bunch of money and I want to invest and I want to work directly with the entrepreneur. And so these became like super angels. You then also see like accelerators. For example, you see like Seed Camp, Techstars, 500 startups. The most famous one probably Y Combinator, who became like an accelerator who helped an enormous amount of companies. Short side note, the current president of Y Combinator, Geoff Walston, is actually an INSEAD alumni. I recently did an interview with him. If some of you are interested in the interview, maybe just kind of write a yes in the chat. I'm happy to kind of send you the interview later on. It's like a bunch of videos where I asked him a few questions I thought interesting. Okay, oh super, all right. Okay, this is very nice to you. I'm gonna share the link with you. And now more recently, right in the 2010s, you have things like Kickstarter, AngelList, and so on, right? And you see, look, this chart ends till 2010, but there obviously continue to be innovations, right? There are ICOs, initial coin offerings, there are SPACs and stuff like this. I'm not gonna go into the details of all of these, okay? But this is very much the kind of idea that this industry continues to innovate in many ways. All right. So let's have a look at INSEAD and VC here. Some people have asked me about, like, I want to keep the navel gazing very short, but let's do this for a second. How relevant is this for INSEAD MBAs or EMBAs? Generally, INSEAD MBAs are very good at raising funds. Have a look at this chart here from 2019. I didn't take like 2020 because of COVID, it's a little bit off tracks. And I actually don't know if they actually created this chart, to be honest. So what you can see here is, right, like number 1 is Harvard, Stanford, MIT, and then on place number 6 is INSEAD. And INSEAD graduates have raised more than $10 billion US. I'm extremely happy with INSEAD performance in this chart for 2 reasons, because there are 2 aspects in here, the dimension we are competing on, which actually makes us look quite good. The first thing about this is, if you only look at non-US schools, INSEAD is clearly the number 1. The next non-US school would be London Business School on number 12. The second aspect about it is, INSEAD in the top 10 is the only non-university, which is a standalone business school, right? So if you take these 2 aspects into account, INSEAD is actually scaling enormously well, okay? If you look at the kind of companies for which INSEAD MBAs raise funding, it's really all over the place. And frankly, this just kind of reflects the diverse body of the INSEAD students. All right. Here's an example. One of you has already mentioned this. Adam mentioned it. So this is the example of TransferWise. Some of you might have used TransferWise. It's an international monetary transfer. And it was founded by one of the co-founders is Tawhid Tinkikus. You see him here on the left-hand side. He went to INSEAD in 2010, and he got really annoyed by the money he had to pay in international money transfer fees. He was basically transferring money from his home country, Estonia, to France, and was like, look, how can this be that all you do is like one shitty transfer, then every time I have to pay like 1 or 2% of the money here, you're not doing anything for this. And being the entrepreneur he is, he then created TransferWise, which is now valued with a few $1 billion. Again, if you're interested, I'm in the process of finalizing a case study on TransferWise. So I've talked a lot with Tawhid about this, and it's been a super fascinating story. So if you're interested, I'm happy to kind of let you know about when this comes out. Maybe I do like a workshop like this with Tawhid. All right, okay, super. So there seems to be like a certain amount of, among the people who have not yet frightened out of the seminar, there seems to be a lot of interest in this. Okay, super. In general, Europe, in particular Paris, is getting better for venture capital. You can see this here, French venture capital fundraising shows startup money is pouring into Paris. Look, the whole world has become more venture capital. There's no question about it. Silicon Valley is still the place with the most venture capital, but in general, there's an enormous amount of capital basically flowing around. Michelle, I do not know, I don't have any specific data on Amsterdam, but I believe there's actually like a good business angel scene in Amsterdam, if I recall this correctly. So it should be doing fine. But you see, the thing about it is, in particular within Europe, it's relatively easy to actually raise your venture capitals in like other locations. Yeah. So sometimes INSEAD MBAs also go directly into venture capital. What you see here on the right is a former student of mine, Spencer. And I remember Spencer was a student of mine in the very first cohort I taught in 2015. And Spencer was always like, yeah, Henning, I will go directly into venture capital. And I was like, yeah, good for you. And off he went. He actually kind of teamed up with Brent Hoberman, the founder of lastminute.com, and they created a $60 million fund and recently created a second fund with more than $100 million. And they're actually doing fairly well. So, bottom line about this is INSEAD alumni have successfully operated in and with venture capital. And you do not have to be in Silicon Valley to actually get a lot of venture capital if you want to. All right? Short disclaimer at this point, all right? VC works a little bit differently in different countries. It matters enormously whether you're in the UK, whether you're in Japan, whether you're in Europe, whether you're in the US. I will mostly take a US perspective simply because this is where we have the most data. This is the market kind of I understand the best. I operate these days mostly in Europe, but this is how I've been educated, so I still know that market. There are different differences. So you can see this tweet here, for example, from Dan Forbes. Although Europe has many large firms, they don't buy startups at the rate US firms like Cisco do. This makes it riskier for VCs to invest in European startups as VCs need exit path. This might be an opportunity for buyers elsewhere. So what this tweet actually shows you in a very nice way, right? We have talked so far about how venture capital actually shapes the economy, but here you can also see, look, the economy also shapes venture capital, right? If there are not a lot of kind of exit options, it's much harder to actually engage for venture capitalists. While there are context-specific differences, most of the issues we discuss actually in context, okay? So most will hold across different contexts. All right. What we will do is we will generate both perspectives, okay? So I'll take Gloria to your question. What of Africa? I don't have good data at my hands on this, but I actually know a few business angels and venture capitalists investing in Africa, and they are saying like, look, this is a market which is kind of growing and growing and growing. So I think in Africa, my understanding is that venture capital and business angels are really, really on the rise. So what we generally talk about this market in detail, we will take the perspective of an entrepreneur, okay? And as we take both of these perspectives, we ideally get like a well-rounded picture of the industry, okay? Please, you know what, let me kind of maybe, instead of you typing this into the chat, let me maybe kind of quickly launch a poll. This is a little bit easier. Also gives me an opportunity to show my Zoom skills. Of course, some will say if you would be really good on this, you would have kind of done this before. So maybe you can let me know what you're interested in, if you're more interested in investors or entrepreneurs. Ten, 9, 8, 6, 5, 4, 3, 2, 1, 0. All right, as you can see, there's a little bit more of a focus on the investors and the entrepreneurs. In the past, I've also sometimes given the option to actually both. A lot of you have actually written in the chat that you're interested in both. Here's the thing about it. You are typically doing best. Understanding both perspectives will make you more effective, all right? So no matter what perspective you're in, you really benefit from taking both perspectives life, but it's also true in your personal thesis. If you ask me about a single trade, what I'm going to say about in the next 5 minutes is, I believe, like the most important insight. And interestingly, the insight most people get wrong about the venture capital industry. All right? Here's the thing. You need a partner that is interested and interesting. It's as simple as that. That, by the way, is true in all kinds of contexts. All right? If you are looking for somebody to hire, an employee, you need to have somebody who's interesting, but also interested, okay? If you're somebody who's interested, who's not interesting, that doesn't particularly help you. Let me put you this in dating terms. You need a partner that is attractive and attracted, all right? if there's somebody who's attractive to you, but is not attracted to you, that's a recipe for heartbreak, all right? If somebody is attracted to you, but is not attractive to you, it becomes a major annoyance, all right? This is not different for entrepreneurs and venture capitalists. If you're a venture capitalist, you want to have ventures that are attractive to you, but also attracted to you. And if you're an entrepreneur, you really want to have a VC that is attractive to you, but is also attracted to you, okay? So, let me kind of take this dating analogy a little bit further. The way this works, right, you first attract a partner, then you select the partner, then you write a prenup. By the way, if you don't write a prenup, you basically just outsource this to the local government for you to do it, okay? There's still a regulation in what's going to split up, what's going to happen if you split up, and then eventually you're happily married ever after. Now you might say, well, Henning, that's not a good analogy because a marriage really lasts for life. And I would say, like, look, the average collaboration between a venture capitalist and the venture at this point lasts longer than the average marriage in the US. So this actually goes quite a long way, all right? So let's start here out with the VC perspective, all right? So we take the venture capitalist perspective in how you get access. The key thing from the venture capitalist perspective is, can the venture capitalist attract deals? This is just another way of saying, okay, are there many ventures who want to have money from that venture capitalist? All right? And here's what, interestingly, most people who sign up for this webinar are interested in: how do you screen ventures? How do you evaluate them? How do you negotiate? How do you collaborate with a venture? And it turns out that most of the performance of business angels and venture capitalists depends on the access you have. Okay? If the founders of companies like Facebook or Apple or Stripe or Tesla want to have money from you, it doesn't really matter whether you're bad in evaluating. It doesn't matter whether you're a bad negotiator. It doesn't matter whether you're bad in collaborating. You will still become filthy rich. By contrast, if the only people you have access to, or the people you attract, are basically stupid entrepreneurs, it doesn't matter how good you are in evaluating these companies, or how good you are negotiating, how good you are in collaborating, all right? You will not do well. The odd thing about it is that most people are focused on screening and evaluating. And I'm not saying that's not important, but the most important aspect is access. Let me for a second go back to my dating analogy, all right? And let me frame this an example in a way that it will particularly appeal to heterosexual men, okay? So, the heterosexual men I know who are currently dating don't have the problem that they say, oh, I have all these women calling me, how should I evaluate them? No, they know exactly the kind of women that is attractive to them. Their problem is that they are not attracting women. So they shouldn't take a class in how I become better in evaluating women, but they should rather go to the gym and work out, or they should go to the library and invest in intellectual capital, okay? They have a pretty good understanding, all right? So don't worry so much about who you want to work with, very much more about who wants to work with you, all right? Sure, we will figure out the evaluation, the negotiation part, and the collaboration part, okay? But my dating in life did not fail because I was bad in writing a prenup, okay? This is not the biggest problem I had in my dating life, okay? Pershka asked if there's a class by you on attracting women. You know, let's see what the sign-up would be. There's a surprising similarity, I believe. So, this tweet summarizes it in a very nice way. It's basic, but I can't stop thinking about this. VC is an asset class where the best assets pick their investors, all right? Think about this. VC is an asset class where the best assets pick their investors. What this means is the startup structures like a magnet, all right? So let's think a little bit about what you do. You need to attract the high potential entrepreneurs. Very important. Exactly, Mike. How do you build awareness? So let's talk a little bit about this. I separate the strategies into two categories, and the one I call fishing and the other I call hunting. So fishing is you wait for ventures to come to you, and hunting means you search and contact ventures directly. So let's talk about fishing first, all right? Fishing, the idea is, I'm probably doing not justice here to fishers, but you basically stand in a place, right? Here's a fly fisher, but otherwise you basically stand in a place, right? And put this into the water and then wait for fish to you to come. But you need to have something which attracts fish, all right? So here's the most important thing. Nothing attracts like success. We see that we're successful early on, tend to remain successful. The dynamic is very, very simple. You see somebody whose venture capitalists or business angels, whose ventures became successful, and then you assume, oh, that business angel, that venture capitalist must be really good, so I want to go to the same kind of company. The same, by the way, is true for business schools, right? People who apply to INSEAD see, oh, look, INSEAD students have gotten great jobs after graduating and have made an enormous amount of money. That must be a good school. And so as a result, I'm very lucky because I get fantastically good students into my classrooms, right? And hopefully I tell them one or two things that actually help them to be even more effective, but then they become enormously successful, but mostly because they were already super smart, all right? But we continue to attract very good students, right? So outstanding success early on affects the VC's ability to attract ventures in the long term. There's actually a very nice recent paper by Raman Ananda, Samila, and Olaf Sorensen, which shows that venture capitalists, which were successful early on, tend to remain incredibly successful because they continue to attract strong ventures. So, what can UVCs do without a track record? All right, because that's obviously a question, right? It's really nice. It's really nice, obviously, if you already have a track record, right? But you might not already be successful. So what can you do? So have an attractive background. Here we are going back to the example to Andreessen Horowitz, and on this cover you see Mark Andreessen when he's still at Hare. That's the bold guy you saw in the other picture, all right? And here he is, 21 years old, all right? 21 years old on the cover of Time magazine, all right? He was a software engineer superstar, right? At the time, long before he actually created the company. What you can also do is to engage massively in PR activities. So you want to be known for the thing you do, right? Andreessen tweets 50 to 200 times a day with an average of 120 tweets a day. They have a fantastic podcast. They're writing best-selling books. And you can see this. They make it into the New York Times, right? Andreessen Horowitz, the deal maker to the stars of Silicon Valley, all right? Here's a very, very important thing when you attract attention, all right? Don't worry about attracting attention from anybody. You need to have attention from the right kind of people, all right? So this is really not about you writing like a LinkedIn post, okay, where you say like, press like if you think Lionel Messi is the best soccer player ever, and then all of your high school mates actually press like, and the others say, no, it's Ronaldo, and you get like a lot of engagement. You actually need to have engagement on the topics you care about from the right kind of people. If you want to invest in artificial intelligence startups, all you need is the attention from people who are creating business in that context, okay? You might also run events, all right? The best way to get invited to the party is to host the party, all right? And I know this because I don't get invited to a lot of parties, but I've started hosting my own parties, and suddenly you're actually able to kind of build a bit of a network, all right? You want to have strong expertise, and you make sure that people actually know about it, all right? So here you can see like a nice example of it. Andreessen Horowitz actually has created like what they called an AI playbook, which was at the website where they basically said like, look, these are the kind of things which are currently going on in artificial intelligence, and that sent a very, very strong signal to everyone to say like, look, I have an artificial intelligence startup, this is for me, the investor, to go with, okay? You'd also build a reputation for great people and great expertise. So here you can see, for example, the team of Andreessen Horowitz. And if you look closely here you see the investment team. But if you look closely below the headline, you see there's an investment team, a market development team, an executive talent team, a technical talent team, a marketing team, a corporate development team, an operations team, a board partners team, and special advisors. So these are all the people you can work with if you invest, if you get an investment from venture capital. And you see that's quite attractive for startups, because they would say like, look, this is suddenly becomes like my talent pool in which I can then tap into, right, and work with these people to make my startup a success. The other thing, and this is something I like quite a bit, is you need to have a very clear and appealing message, all right? So let me give you an example. Very often, venture capitalists end up replacing the CEO of the ventures they invest in. And this is not necessarily a bad idea, okay? Just because somebody was good at taking a company from 0 to 1 doesn't mean that the CEO is necessarily qualified to take the company from 1 to 100, all right? I've myself been in board meetings where I kind of suggested, look, the CEO needs to go. But here's the thing, typically founders do not want to be replaced as a CEO. They like to lead their own company and they always consider themselves competent. Okay, so what Andreessen Horowitz said, like, we will actively work with founder CEOs. And that was a message which was incredibly appealing to founder CEOs, right? Because founder CEOs want to remain at the head of their own companies. Okay? So, now we have talked about fishing, let's go to hunting, all right? So, how do we seize hunt? You headhunt people from your personal networks, right? You might know potential founders, and you kind of say like, look, don't you want to create this company? Why don't you think about it, right? You might actually know an executive or like a researcher at a company and say like, look, you have a great idea, why don't you commercialize this? I might invest in it. You interact with teams from failing companies. You might actually see like a bunch of founders who try to create a company, but then fail. And you might actually say, look, this was a very good attempt. You just need to pivot a little bit. Let's try this again. You create a new company and I'll invest in it. You interact with universities, right? You see a lot of innovations actually come out of universities, right? You might actually know like a young assistant professor, a master student, a postdoc or so, who has like a great idea for a vaccine, has a great idea for a laser, and you might say like, look, I'm going to help you to actually make this company a success. Or you can act as a judge in an idea competition. Every time I teach these classes at INSEAD, I ask the venture capitalists and business angels to come to my class. And despite having incredibly high opportunity cost, these people tend to come and are very patient and giving feedback to students. And it's really nice to see. And they say like, look, we actually want to keep our finger on the pulse. And it's happened quite a few times that they actually ended up investing in these kind of companies. All right? So, look, there's another aspect about this which I find interesting in the entrepreneurs you really want to invest in may actually not look for investors, right? So sometimes you need to find people who are not looking. So please do not answer the question. I will give you a poll in a second, but think about it. How big do you think is the overlap between people who want to become entrepreneurs and who are good entrepreneurs or have good ideas? Okay, so is it like A? There's no overlap. So we have people who are likely to become an entrepreneur and we have people with the potential to be great entrepreneurs. Or is it like B? There's a little bit of overlap. Or is it like C? There's quite a bit of overlap. Or is it like D? There's almost total overlap between the two. Alright, let me kind of launch another poll here. And let me launch another poll. And then you can actually pick overlap. See. No need to type into the chat. You're going to have a poll in a second. All right. Are we in a scenario like A, B, or C? Or D? 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. So you can see most of you believe we are either in scenario B or C. All right. Some of you believe there's absolutely no overlap. Some of you believe there's total overlap. Let's assume we go with the wisdom of the crowds here for a second and believe it's B or C. It's actually not easy, right? It's actually not easy to kind of give a good, to say like, to do good research on this, but we're probably like in a B or C scenario. What I want you to focus on are the implications of this, all right? So let's assume we are in B. One of the implications of being in B is you can see there's an enormous part which is blue but doesn't overlap with the red, okay? So this means most people who are likely to become entrepreneurs don't have the potential to be great entrepreneurs. And for you as a venture capitalist, this really means that the answer you need to give most often when somebody wants to have money from you is no, all right? Most people who will come to you are not good entrepreneurs, all right? If you find yourself saying yes very often, you probably don't attract great entrepreneurs, or you just don't attract enough, okay? You actually need to select, all right? There's a very nice quote by Mark Andreessen who says like, so Mark Andreessen, for example, or Andreessen Horowitz said at some point, they got every year 4,000 applications and they invested in about 20, all right? So if you actually, your chance of raising money, if you applied for raising money, was actually about 0.5%. And he pointed out that they became very good in writing rejections because he said like, this is the most common thing we do. By the way, if you're interested in rejection, I'm an expert on rejection, not because I got rejected a lot in my life, but also because I actually did formal research on rejections. I've devoted like 5 years of my life to study rejections. So if you're interested, like if you're a person who gets rejected very often or actually needs to reject people in hiring and you want to learn about it, type like a simple yes in the chat and I'm going to send you like the papers and a little bit more background knowledge. Okay? Okay, glad that there's so much interest in rejections. Fantastic. So, but there's a second implication of this, let's stay in B. So we have now talked about the blue part, which is not overlapping with the red. But there's also an enormous part of the red, which is not overlapping with the blue, okay? So there are lots of people out there with the potential to be great entrepreneurs, but who are unlikely to become entrepreneurs. And so if you have money and you want to actually invest in people, right, you might really kind of consider sometimes talking people into entrepreneurships. You might know somebody who has no intent to becoming an entrepreneur, but would actually be a great entrepreneur, okay? So, be good and disciplined in rejecting, in saying no, all right? But also, you may want to convince people who have talent to be an entrepreneur, but aren't willing to become one, okay? Who have something up their sleeves they might not even themselves be so aware about. All right, so we have now had the venture capitalist perspective. We are now flipping to the ventures perspective, all right? So here we examine access from the entrepreneur's perspective. But the case, if you wonder, all right, this is obviously, we could go on and on these topics for more and more hours, right? I'm giving you a relatively short summary here. It's an overview. I'm very aware that we can take a deeper dive. I plan to do a few more of these webinars in the future. So if you're interested like in a deeper dive, you're more than welcome to join these webinars in the future. But now let's, for the moment, let's have a short look at the ventures perspective. So, raising money is an activity entrepreneurs need to be good at, okay? Of course, if, in particular, if you're in a high kind of capital intensive industry, all right? Whoever decided that the word fundraising should start with the word fun had a sick sense of humor, all right? This is actually a lot of work and it's not necessarily fun. So I've been teaching this a few times. People have also pointed out that the word funeral and the word fungus also starts with fun. So I've become very skeptical at this point in my life of all the words that start with fun because these things typically tend not to be super fun, all right? So But jokes aside, this is actually a serious work you need to do, right? You need to plan the operation fundraising. First thing, timing, all right? Founders generally underestimate how much time fundraising takes. I recently worked with an entrepreneur who had a little bit of like a, so we talked afterwards, and he had a little bit of a tragic outcome. He had a company which I thought was absolutely fantastic, great market niche, had already acquired customers, and was on a clear way towards profitability, but was not yet profitable, okay? Was still burning money every month. It was very clear, you could kind of predict when this company would become profitable, fascinating company, great team, but was not yet profitable. He still had money for 6 months in the bank, all right? And so I realized, okay, I need to raise money now. So what happens? He has 6 months, all right? Of those 6 months, it takes him 3 months to find a venture capitalist he is interested in and who is interested in him. You remember, attractive, interested, interesting. That took him 3 of the 6 months. Then they are conducting a due diligence, and the investor said, like, look, we insist that for the due diligence we have exclusive access. That due diligence ends up taking 10 weeks. All right. Here he is with 2 weeks of capital left, and at the end of the due diligence, the VC says, you know what? We thought carefully about it. We are not going to invest. The next thing the founder did is that he immediately filed for bankruptcy. All right. So the key thing about this here, you need to raise money long before you need it, okay? The more you need it, the harder it will get, all right? Please don't do this, all right? In the early days of FedEx, the CEO, Fred Smith, needed money to keep the company alive. He owed $24,000 for a fuel bill. After a business loan was denied, he bet the company's last $5,000 on the blackjack table in Las Vegas and won $27,000, which covered the fuel bill and saved the company, okay? This is not a way to finance your company. I would also, I feel obliged to say, you're not allowed by regulation to gamble with company money. So please don't have any ideas and go out of this call and start gambling with your company's money, all right? So you need to organize the fundraising. Have very clear internal responsibilities on fundraising. There's a nice paper by Indra Maurer and Mark Ebers which actually shows this for biotech companies. Because you see, talking to investors is very different from working on a molecule and engaging with the scientific community. So what they actually found is the ventures did best with like a small team which was totally focused on interacting with investors, and the rest of the company continued to do the operational business. Mixing the two did not go particularly well, all right? You attract via signals, all right? Here's something which I always find quite sad, but it's also very relatable. Most investors want to invest in companies that would succeed without them. Most employees want to work on products and teams that would succeed without them. The best way to get help is to get yourself to a place where you don't need help. If you've ever tried to raise, to get a bank loan in your personal life, you know this to be true. If you have plenty of money, it's very easy to actually get a bank loan. The bank actually asks you to loan you money. By contrast, if you really, really, really need the money, the bank thinks of you as like a horrible risk and is not keen on giving money to you. All right? So the best way to get help is to get yourself to a place where you don't need help. So look, ideally you raise money. So I talked with David about this with TransferWise, and they raised money when they were cash flow positive, were growing like crazy, and everybody wanted to invest in them. And he actually said to investors, look, just to be clear, we don't need the money. Okay? And so suddenly it's the investor who really says, like, look, I want to invest, and that's obviously beneficial for your valuation. You need to send the right signals, right? So you already need to have accomplishments under your belt, both to get on the radar of a VC and to survive the screening process. For the lack of a better term, try to be a winner, all right? So have traction in your operational business, find ways of standing out, for example, by winning prizes and so on, all right? You want to kind of look attractive to the venture capitalists. It's also crucial for the timing of raising funds. The best time to raise funds is after you have accomplished something, all right? Look, when does INSEAD does the INSEAD PR department kind of go all gangbusters on LinkedIn? When INSEAD becomes #1 in some ranking, right? That's when we intensify PR activities, right? So whenever you have like some accomplishment, that's when you want to move out. When you've shipped your latest product, when you've successfully filed for a patent, when you've made like a fantastic hire, this is how you time the moments, all right? So let's talk a little bit about screening, all right? We take the VC's perspective, okay? But before we take the VC's perspective, I would now like go back to the limited partners and put you into the shoes of a limited partner, all right? You remember who the limited partners are. The limited partner is the person I'm not because I don't have enough money for it, okay? So the limited partners are the people who invest in venture capitalists. And what I would like to do with you is to put you in a position that you are the limited partner where you actually need to evaluate the venture capitalist, okay? So that is something, for example, I have been asked this by like a family office recently. Can you evaluate like a few venture capitalists for us? We're thinking about investing in a fund, and could you evaluate this kind of venture capitalist for us? Okay? So what you do is you act as a potential LP, deciding whether to invest in the fund of a venture capitalist. Okay? I will now give you an exercise, and that is what you need to do. Jyoti, with respect to the question, the family office is typically like an office or an institution which represents literally a very, very rich family, like a founder family or so, from a family company of like a few billions on the side and now need to invest this money, okay? So you act as a potential limited partner, deciding whether to invest in the fund of a venture capitalist. So what I will give you is, I will give you the track record of a venture capitalist. You will learn about their investments, and then you need to judge whether you think that venture capitalist has promise for the future. So you need to assess whether VC made the right decision, okay? So I give you some of the kind of key decisions the venture capitalist made, and you need to assess whether they made the right decision. The listed venture is a real venture, okay? But it is disguised, all right? Imagine you would evaluate this venture in 2013. By now, in 2021, it is evident whether it became a success or not. Look, the reason why I give you ventures from 2013 is very simple. I want to tell you afterwards whether you were right in kind of your assessment, okay? But to do this, I actually need to take ventures where by now it's clear whether they became a success or not. Look, this is also a great opportunity for you to mentally leave the year 2021 and to go into the year 2013. There's no COVID, there's no kind of curfew, you can just enjoy your life, okay? What I will do is, so I will give you a survey, and your job is then to evaluate a venture capitalist and the investment that venture capitalist has made, okay? If you have a question, please send me a private message. In your chat, you have this box where it says to, and right now it probably says to everybody, and you should just switch that to Henning Pisunker. So send a private message just to me using the chat, no public questions, all right? And please fill in all of the survey. You will get information on the different ventures. I will also give you a little bit of information on the network of the venture capitalist, okay? Who is the venture capitalist connected to? How are they connected? And you should pay attention to this and say like, okay, because the network and how the venture capitalist is using that will probably also affect the future ability to kind of make good investments in the future, all right? So what I will now do is I share with you a link. Wait a second. In the chat. And I will give you now 25 minutes to complete that form, all right? And if you do this carefully, 25 minutes is not a lot. You need to evaluate the decisions on 4 ventures, all right? So please have a look, evaluate these ventures, all right? And we're going to discuss these afterwards, all right? So have a close look, try to evaluate the ventures, pay attention to the substance of these companies, how the venture capitalists kind of make use of the network, and if you have a question, send it to me via chat. you have now 24 minutes. So, because some of you know, all these companies, um, all these companies are real companies, okay? But I will say the following. I have asked 9 PhD students to evaluate, to guess who are these 4 companies are, and they had half a day of time. Okay, they have the whole morning to say, like, let me kind of guess who these companies are. And of the 9 PhD students, 1 person got 1 company right. All other guesses were wrong. So please don't expect that you're going to get anyone right. Every time I teach this, somebody says, like, I know the co-founder of this company, and I've always followed up with them, and nobody ever knew any of the co-founders of the company. So just kind of judge them on their own merits, and keep in mind you're also kind of focused on evaluating the venture capitalist, whether the venture capitalist kind of made the right decision.